Welcome back to another episode of That Backyard Property Pod. Today is a little different. We're doing some mini-series. And so what we're going to look at is a bit about my world, so the mortgage home loan area. And so what I'd love for people to do is to reach out with any questions, any thoughts that you have, and I can tackle it here in these minis, which will generally go for 10 to 15 minutes. Today, we're going to look at how parents or family can help you buy a home. It's such a common question that I get asked every single day. And so it'd be great to tackle a few of those points. There's 4 common ways that parents or family can help their kids or other family members to buy a property. Those 4 ways is a gift, a favourable purchase, purchasing together, and the last one being a guarantor, so a security guarantor. So I'm going to cover off each of those points in a bit more detail. So the first one's pretty straightforward. It's a gift. And so as it sounds, family member is gifting you money. What the bank wants to see from this as an application is a letter or a stat dec stating that the money being gifted is not repayable. Because the last thing the bank wants is for a family member to pay or gift some money and expect it to be returned. Now, obviously, you might have some other arrangements in the background, but from a bank's perspective, they want to know that that money that's being gifted is not repayable. Now, one key point around that is you don't actually need the money to be in your account. So the parent or family can sign a gift letter or a stat dec, and then we can just provide that to the bank as part of the application. So the money doesn't even need to be in the account. And one other part around this is when you're borrowing 90% of the value of a property, the banks want to know that you have actually saved some of that money yourself. In most cases, you need to have the money in your account for at least 3 months. It's key to know that you can use a rental ledger, the sale of a car, the sale of an asset. So there are plenty of ways we can get around this. But if you are getting money as a gift and we're trying to borrow more than 90%, it is important to try and have that money in your account for at least 3 months. So that's one way to do it. Another way is favourable purchase. And this one's quite an interesting one. So this is where a family member actually owns a property already and they're looking to sell that to you at a discounted price. And the way that works is if the property is, say, worth $800,000, the bank will then let you borrow up to 80% of that value, which is $640,000. So what could happen in this case is the property gets sold to you at $640,000 and you get a loan for that. But the reality is the value of that property is worth $800,000, which means there's no mortgage insurance. One really important thing to note on this one, though, is that the government and generally the Office of State Revenue will still value that property to make sure that you are going to be paying full stamp duty at whatever the true value is. So this is a really interesting way of doing it, and it can only work if the family member is selling that property to you as the individuals. And so when you're looking at the loan amount would need to be 80% of the value of that property to avoid mortgage insurance. Now, before you go down that path, it's really good to get a full valuation on that particular property so we can work out what the stamp duty would be, so we can factor that into the loan amount or into your savings to make sure it can be covered at settlement. So a really quirky way to do it, but I see it quite frequently. Another way of doing it is the parent or family member actually purchasing the property with you. So in most cases, the banks want that family member to own at least 20% of the property. So in this case, you can actually determine what percentage ownership you have. So if I was buying it with my mum, then what I could do is I could say I'm buying 80% of the property value and my mum is buying 20%. Bankwest is the only one in there that will allow us to do it at 10%. And the reason why you might look at a lower percentage amount is that over time, you might actually want to purchase that portion back off parents when you're in the position to be able to do that. So the way this works is there's two options. If a family member is buying it with you, they can either be on the loan as a borrower, which generally isn't preferable from a parent's perspective because they don't want it to impact or hinder their future borrowing numbers or calculations. So in that case, full application in the original scenario, I would be buying it with my mum and we would both be borrowers on there on an application for the bank. And so that way is not as preferable as the second way. The other way we can actually do that is we could buy it together and the family member can actually purchase their portion of the property, so call it 20%, with their own savings or cash. And so in that instance, if the family member is buying their portion with cash, they don't need to be a borrower. And so there are banks that will allow the parent in that case to not even be included as a borrower on the loan. They would obviously need to sign papers to allow you to get a loan on a property that they part own. But in that case, the family member doesn't even need to be on the loan. It doesn't affect their credit score or their ability to borrow money in the future. So it's a really common way of being able to do this because the family member is effectively investing in the property whilst also either providing their additional income to help increase the borrowing capacity or providing cash as a contribution so that you don't need to provide any cash if that's the way to do it. So there are three ways to do it. The most common way, and we probably hear about this all the time, is using a guarantor or a security guarantee or a family guarantee. There's plenty of ways that banks call it. There's even called family pledge. And so in this instance, it's a little bit more complicated. And so what the basics of it are is that if I go out and buy a property and then I need my parents' help, which I did originally when I bought my first home, they have their property here. And so when you purchase this property here, the parents' property then sits in behind your one as additional security. And the reason that happens is to avoid mortgage insurance. That's one reason it happens. But the bank then has more security on the loan or debt that you're taking out, which makes it less risky. And so in this instance, you've got your property that you're purchasing and the parent's property behind it. Now, there's a couple of really key points to note, and I'd encourage you to send this through to a family member that you're thinking of getting their help as a guarantor, or vice versa. If you're listening to this and you're wanting to provide a family guarantee to a child or your family member, then definitely send this through because there's some really key points from both aspects. So from a parent's perspective or a family member that owns the original property, what you need to be aware of is that it's easier for that child to get a loan through the same bank that you have the loan with, if you still have a home loan. If you don't have a home loan and you hold the original title, then you're going to have to relinquish the original title to allow it to sit behind your child's property. So in that instance, if you do have a home loan, it then determines which bank they go with. And so in that instance, it becomes even more tricky because what we need to do is we need to work out what your current loan balance is and then work out what the value of your property is. Now, most banks won't let a guarantee happen if the loan amount is more than 70% of the value of the property. If it's less, then you should be okay. If you don't have any debt at all, any home loan on your property at all, then it's really, really straightforward. What requirements do you need as a parent in this instance? So obviously the debt is one of it, but also what do you need to do as part of the application? Now, all banks operate very differently. And so in a guarantee perspective, there's about 5 or 6 banks that don't need any income or asset or liability verification from the parent. They just need ID, and everything else needs to be confirmed in writing, but it doesn't need to be evidenced. So in that instance, it's really straightforward process for the parent because they're just providing ID and then some information. Other banks will need a full suite of income documents, liabilities, and expenses. So when you're talking with your broker, just make sure that you're aware of the implications of going from one bank to another when using a guarantor. So in that instance, if you were to go down and say, well, we're using a guarantor and the parents provide the ID and the information, it's really straightforward. In some cases, the parent will also need to get legal advice. So just be aware of all the different aspects of this because it can be quite cumbersome for the parents. It's definitely a benefit for the child, but it can be quite cumbersome. So the more information you have around this, the better. One key concern that I see from parents is when can I be removed as a guarantor? It comes up all the time, and understandably so. In this instance, if the guarantees happen, the purchase has happened, and the parents are on as a guarantor, what we need to do every 12 months is we need to revalue that property, the child's property, the one that's been purchased, every 12 months. Because what we're trying to do is we're trying to get to the point where the loan amount is 80% of the value of the property. So as the value increases and as the loan is being paid down, that gap widens. And the further that gap widens, the easier it becomes to removing a guarantor. One main part around there, though, is that each bank values properties differently. So when it comes to this, the broker is so crucial in the ongoing process to make sure you're doing a valuation every single 12 months to get to the point that the guarantor can be removed. It is worth noting that the guarantor can be removed at any point of time before that 80% to 20% gap is made, but mortgage insurance would be applied. So the average time that I find guarantors being removed is generally 4 to 5 years. Obviously, what's happening in the Perth market recently has meant that this has sped this process up and we're removing guarantors within 12 to 18 months. But generally, it takes 4 to 5 years. In those 4 to 5 years, though, it's important that the parents understand that if they want to do anything with their home and their loan, that it can be impacted by the guarantee. So if they're looking to use their property to buy another one, or whether they're going to sell that property and downsize, it's important to understand that that will impact the guarantee that's provided to the child. So if you do want to, let's say you want to sell the property, the parents want to sell and downsize. In that instance, what can happen is the existing guarantee can actually be ported across to the new property. Sounds complex, it's really straightforward, but there are a few moving parts. So I think the really important point to note here is that you need to keep aware that it could take 4 to 5 years to remove a guarantor. And in those 4 to 5 years, it's important that evaluation is done every 12 months so that we can determine when the guarantee can be removed. So there's some really key points around what that looks like from an application perspective. What benefits are there to having a guarantor? There's a couple. The main one is to avoid mortgage insurance. So I'll touch on mortgage insurance in another podcast and we'll link it below. But that's one of the main parts. So avoiding mortgage insurance. The second one is around the interest rate. The interest rate will be a discounted amount in comparison to what it would be if you're borrowing in mortgage insurance territory. So the costs associated with using a guarantor are so much further removed, either fully removed or reduced by using a guarantor. So when you're looking at the benefits from a child's perspective, it absolutely makes sense if a family member can provide their property as additional security. So there's plenty of different ways that family members can help children or other family members get into the property market. They're just a number of ways that we see happen very frequently. And what I would encourage you to do is to have a listen to this, take some notes, and have those questions asked of the family member that's wanting to help, because most family members do want to help. That bank of mum and dad is real. The problem is that most people don't know how to actually go about doing it. So take notes from this episode, reach out with any questions. Feel free to make contact as well, because the more information you have before you broach the subject with a family member, the better. And the other really key part that I find is that understanding what the benefits are from both parties and what the negatives are as well is important to have as part of that conversation, so that everything can be on the table at once. Having a professional, having a broker involved is key. So reach out, happy to help, and send through any questions when you've got them. Cheers.